Welcome back. You're watching First Trade, and the market is nearly 75 points of today's low, hovering around 23,140 on the back of good put writing, which we are seeing in 23,100 levels at this point in time. So the Nifty is down nearly 1/3%, and there's an open interest jump of nearly 0.7%. The Nifty Bank, if you look at in today's trade, it's something which is down today at nearly again one third, nearly 1.4. It's up 1.15% there, and there's a long build up which is happening with open interest up nearly 2% in Nifty Bank at this point in time. Look at the constituents of Nifty Bank. You see long bull positions getting built up in ICICI Bank, Axis, IndusInd, Kotak, Bandhan. HDFC Bank is seeing some short build up which is happening. SBI is also seeing a long build up today in today's trade. So primarily a long build up coming in many of the banking stocks and in Nifty Bank. Among the put and call writing, you'll see a lot of activity happening in 23,100 with put writers active at that strike of 23,100, and the distribution also shows a spike coming in at 23,100, which gives some support for the market there. So the market hovering between 23,000 to 23,500 level with good support now coming at 23,100 for the market. At this point in time. Among the gainers, you have RBL Bank up 2%, long build-up seeing Keynes Tech and Torrent Pharma are the other stocks where we have seen gains of over 1% and long build-up coming in. Among the losers, you have stocks like Oracle, STL Tech, PFC. Again, it's a bad day for IT. Nifty IT index is down nearly 2.3%, and we are seeing fall in almost most of the IT companies into the STL Tech down 3%. Oracle Finance is down nearly 4% in today's trade, and PFC is down on the back of the merger which has come in with the REC. Open interest gainers has Dixon Tech, where we are seeing a long build-up. The Muthoot Finance is seeing a long build-up, and Titan is seeing a short build-up at this point in time. Among the losers, you have stocks like Tata Consumer up in today's trade. They're seeing some short covering coming in there. Good Consumer is seeing a long unwind, and Divis Lab is seeing a shorts getting covered in today's trade as we speak. Most active is ICICI Bank, 1300 June call, the stock hovering about the 1300 mark. The premium up 9 rupees to 29.60, and there's an unwind happening, and it seems it's a shorts getting covered at this point in time. So 99,000 contracts are there's an unwind of 99,000 contracts at this point in time there. Among the puts, you have TCS 2100 June put, the stock hovering above the 2100 mark, premium up nearly 17 rupees to 53. There's 1.34 lakh contracts which have added in open interest there. So the market hovering just about a 23,100 mark there. The Nifty dragging the index somewhat, and Bank Nifty is at this point in time is flat as we speak, with some pressure coming in from HDFC Bank on the index.
Oh yeah, and good recovery, and more so it's the broader end of the market which is actually seeing a better traction. A lot of activity over there. Look at an RBL, look at a Keynes, look at MCX right now. A lot of these names are jumping up. Look at a Dixon as well. That's also covered ground, holding up 0.6% in the green as we speak. But let me now welcome on board Ankur Kharbanda, Deputy CEO at Niva Bupa Health Insurance Company, joining in on the show right now. Ankur, great to have you today on ET Now. Thank you so much for your time. Just wanted to start off firstly by talking about the GWP growth that you delivered in May, around 30-odd%, broadly in line with standalone health insurance. But what were the key drivers of growth? New customer acquisition, ticket size expansion, or was it policy renewals?
Our growth has been very good in the first 2 months, April and May. Largely, we have been expanding in various areas, our distribution network. That helped us, which helped us to get new consumers. If you look at the overall growth, large part of this growth is coming from new customer acquisitions. And the third is the ticket size has also grown, because if you remember last year, the GST government made this product, health insurance, as a essential product and made this as a zero GST product. That has also helped us this year to increase our ticket size. This is still continuing, though it's now 7-8 months now, but this is still continuing. So people are using that amount, GST amount, to take a higher cover, adequate cover for themselves.
Give us a sense of which customer segments are contributing to growth currently. In addition to especially with respect to what's happening from a citizen point of view, or the corporate or the group health scheme.
So as an organization, our focus has been retail. We have a laser sharp focus on increasing our retail business because that helps the organization and the overall, organization. Hence, retail, 70% of our business is retail business. That's the one which is growing the fastest for us. Within retail, what we have seen is the average age of the organization, people who are joining in as a health insurance customer, the average age, which was 37, 38, is now moving towards a 35, 36. It's going down, which is telling us that a younger population is joining the health insurance space. And there is a reason for that as well. We launched a year back, we launched a product called Aspire, which was targeting towards the younger lot, which had features around maternity, which had features around, consumers, youngsters do not feel that they need a health insurance. And there were a lot of features we included to ensure that they are buying the health insurance space. So it's largely retail. A younger group is coming up. The seniors are still taking, but overall, as an average, the younger is coming up. Between family floater and individual, large contribution is now coming from a family floater rather than an individual for us.
Right. And do you believe that the company can sustain growth materially above the industry average over the next 12 months?
Yeah, definitely. I think we are all set to go in the same line for the next 12 months as well. I am very confident. One of the key things which we have within the organization has kept for ourselves is that can we grow 7, 8, 10% more than the average growth of the industry? That's what we've been looking at, and I'm sure not just 12 months, we can continue for the next 24 months. There's a huge potential in India. There are a lot of places whereby the health insurance is not there. They need this product for the sustainability of the family. And hence, I feel we have a role, Niva Bupa has a role, industry has a role to continue this growth momentum. Not just 12 months, I can see this 24 months as well.
Ankur, how sensitive is Niva Bupa to changes in the interest rate cycle, interest rate cycle, and if if the rate hike comes through, what would be the key implications for your investment income?
Look, if the rates goes up, we get benefit, whereby the investment income also goes up. But we play a long-term game. Immediately, interest rate may not have a big impact within the specific year because we are in the trajectory of a long-term investments, not the smaller cycles investments. But yes, interest rates going up helps us. But on the other side, interest rate going up also means that inflation goes up. Inflation goes up means that the disposable income for people also goes down. So there are some pluses out of this, there are some negatives out of this. But what we believe, we have a fairly robust investment strategy, and we have been really delivering on that strategy consistently over the years. Some rate interest increase will help us, but not in the short term, but in the longer term, because we play on a book which is on a longer term cycle.
Right. And as the company continues to scale up, how should one think about the balance between growth and profitability? I mean, are you seeing any pricing pressure, changes in customer acquisition costs, or increased investment in distribution and marketing that could perhaps impact margins?
Look, overall, we are going as per our strategy. The strategy is acquire more consumers. The strategy is go into the Bharat cycle. The strategy is expand your distribution. On the claim side, the strategy is how can we deliver better, and also have a control system throughout the hospital network. This is another thing which is working for us, and ensure that we are every year we are giving an inflation to the consumers as well in a single digit. That's what we have been looking at. We've been very successful in doing this throughout the last 5 years. I think nothing substantial is changing in the market over there. I don't see that the hospital cost is substantially going up. It is consistently going up, and consistently going up. We've also been increasing our, premiums consistently. And the thing which we talk about all across is that can we ensure that we are increasing our price every year less than double digit is what we are looking at, so that the consumer also doesn't pinches it. It doesn't pinches him. That's what we've been looking at. Is there a big threat or something coming up? I don't see any changes, material changes which comes up, which is impacting us. I don't think there is anything like that.
Ankur, you've been spending or investing on brand and scaling up your presence. So, what is the kind of priorities that you have in FY27? Is it going to be market share gain, profitability improvement, product innovation, or distribution expansion?
So we have a strategy which says the first level is the growth, because the purpose of the organization is to give every Indian the confidence to get access to healthcare. Hence, we need to get a lot of people under health insurance. That's one purpose which we have, and for that, growth is important. We would like to continue this growth in the next 10 months from now, which I said earlier as well. That's the priority. But while we grow, another priority which we have is that we need to grow profitably, because we have committed to our investors a higher teen returns over a period of time, and we are on track in delivering that as well, which would mean our combined has to come below 100 over the next few years. We are on track on doing that. That's the priority. But to deliver those two priorities, we are on the growth side, we are expanding our distribution. We're still expanding our distribution. As I mentioned, this year a lot of expansion has gone with the Bharat side. And we will continue to deliver on this. The second thing which we are looking at is how do we grow productivity throughout our distribution setup. That's another thing which we are doing, which helps us in growth as well and also on the bottom line side. The last thing which we are doing is use a lot of AI and tech, which helps us to support the growth which we are doing. And when I say the support, which means the support on claim side, the support on the servicing side, how can we have a non-linear, structure of cost? That's what we are looking at. Deliver better to the consumer by using tech and AI, and also while on the other side we are still, below cost and reducing cost, operational cost going down every year, so that the overall margins goes up. That's our strategy. We've been consistently doing this. I think the real one is execution. We have been doing execution last 5 years. I am very confident that next 10 months would also be similar for us.
Right. Okay, great chatting with you. Thank you so much for your time today then. Okay, on that note, let's take a very quick break. That's, of course, Niva Bupa Health talking about how their quarterly performance has been. It's looking okay for the market. We've definitely recovered quite a bit of lost ground from where we started off. ICICI Bank, ONGC, Adani Enterprises, they clearly are the ones which are the biggest, movers today. Other than that, of course, Axis, Bharti, Kotak, and even Reliance and SBI are now turning the tide and trying to hold their head above water. Both those stocks are flat as we speak right now. So good recovery, and more importantly, good recovery when it comes to the broader end of the market as well. We'll take a break, be right back with more.
Welcome back. You're watching First Trades. Let's go into another company. KRN Heat Exchangers. We're joining us now is Santosh Kumar Yadav, Managing Director at KRN Heat Exchangers and Refrigeration. Santosh, hi, morning. You've been investing in the HVAC facility and which contributes nearly 40% of your revenues. Post this infusion, what kind of revenue contribution do you see and the kind of expansion that you see in the capacity of HVAC?
So, Sanjay, this is our wholly owned subsidiary of our listed entity, and this year we are planning to achieve 15% utilization of the total capacity.
What would be the total capacity for you?
So it's around 2,000 crore.
Okay, give us a sense of the kind of ramp up that you see in the utilization. You said 15% this year, but over a period of time, how do you planning to ramp this up?
So this year we are planning to achieve 50% and next year around 80%.
Just wanted to talk about, your plans for the new facility as well, because what we understand is that you're targeting a revenue of about 1,800 to 2,400 crore rupees from that capacity. And that is 4x the size of your existing legacy business. What would the utilization be here and how would the company's top line shape up once this facility is operational, and by when would that be?
So this facility is already operational, and last year we achieved around 200 crore from new facility. So total revenue, like with old facility and new facility, we achieved last year around 600 crore. And this year we are planning to achieve 50% utilization of the new and old facility was almost our full capacity. So this based on our existing customer, plus we are adding new customer, and we added new products as well in our portfolio. So in new products, we added bar and plate heat exchanger and complete bus air conditioning for automotive air conditioning for bus air conditioning, and refrigerator component for refrigerator industry like roll bond evaporator, frost free evaporator, and WOT condenser and skin condenser. Other than this, we added new product range in heat exchanger as well. So earlier we are making heat exchanger with copper tube. Now we can make with SS stainless tube with for ammonia refrigerant, and complete HVAC system like dry air cooler and ammonia evaporator, and then cold storage condenser and evaporator both. So this new customer plus new products. So we're going to achieve around 50% utilization.
Santosh, you've also highlighted that AI data centers is a major opportunity. Are you already seeing meaningful order inflows from this segment? And how large could the data center cooling business become for you over the next 3 to 5 years?
So yes, so data center now almost this year we are planning to achieve around 4x compared to last year. So you can say last year we achieved around 100 crore from data center, mainly from domestic, but this year around 100 crore we are expecting from export and 300 crore for domestic. So total we are expecting 400 crore order from data center only.
Santosh, you ended FY26 with a domestic export mix of 84-16 kind of ratio. How are you looking at export market at this point in time, and which are the regions that you see more growth coming in for?
So last year we achieved export total around 100 crore, and this year we have opening order 1st of April is 120 crore in our hand. So expecting 200 crore export this year. So you can say compared to last year almost double, and mainly market North America, Europe, and UAE slightly will be down.
And what is the kind of order book that you're currently holding, opening order book?
For export we have 1st of April 120 crore.
Domestic market?
No, for export.
I'm thinking for domestic market, how much is the order book coming in?
For domestic, we have rolling business actually, so we can't describe order booking because we have customer rolling. So they have forecast 6 months, then they have open order for 1 month only. So it's just rolling actually.
You had penciled in a capacity increase of 20 to 25% from in FY26. Now it's 50% jump which is there. What is the kind of potential revenue growth that you see in FY27 because of this increase in capacity and the kind of order book that you're holding at this point in time?
So total top line, we are going to achieve around just double compared to last year, and mainly revenue from new facility only, because old facility is almost full. And from new facility, what I said just before, new products plus existing customer and plus new customer growth. And especially from
what is the kind of margin that you're going to see? Because you ended Q4 with a margin of 18.7. Are you looking at a consistent margin of 18 to 20% in FY27?
So this year, we hope that our margin will slightly upside, because we have now 2 incentive scheme for this year. Last year we don't have any incentive scheme, so this year we have PLI from central government for heat exchanger 5%, and we have already approval from Rajasthan government for RIPS, which is 1.54% for next 10 years. And other than this, export will be just double, so we have slightly good margin in export, and also data center and bus air conditioning also we have slightly good margin. So if I compare these all things, then we will able to increase 1 or 2% compared to last year.
Okay, good to hear that, Santosh. Thank you so much for your time today. Good speaking with you.
Thank you.
Well, good recovery in the markets, but what's really getting singled out is the entire IT sector. Look at HCL Technologies, look at Infosys, look at TCS, look at TechM. And these, of course, are only the large cap movers, but look what's happening in the broader market as well. Look at a Persistent and look at an OFSS. The entire tech basket is under pressure, led, of course, by Oracle Finance, which is now down about almost 4%. So, Darshita is here to tell us about Oracle, which, while it reported better than expected earnings, fell after announcing plans to raise another $20 billion in debt and equity, adding to investor concerns about this massive capital spending that they're doing to fund their AI expansion. Darshita, flag off Oracle Finance, the investor concerns, of course, and the overall IT weakness as well.
Right. Oracle Financial Services could be in focus today after its parent company, Oracle Corporation, reported its Q4 results, and the stock tumbled nearly 10% in the previous session. Now, interestingly, the headline numbers were strong, but the fourth quarter revenue grew 21%, coming in at $19.2 billion, and the cloud revenue was up 47%, with the infrastructure revenue surged 93%. Management has also guided for a robust FY27 targeting $90 billion in revenue. But the street focused on what lies beneath the growth story. Firstly, Oracle's free cash flow for FY26 came in negative at $23.7 billion, while the capex of $55.7 billion exceeded its own guidance. And spending is only set to rise, with cash outlay for FY27 expected to be around $70 billion. Now, to fund this expansion, Oracle now plans to raise another $40 billion through debt and equity. And these fresh fund-raising plans have revived concerns over leverage and shareholder dilution, especially with the proposed $20 billion at the market equity issuance. Secondly, while the cloud revenue grew stronger, it missed the street estimates. Investors were also disappointed by the pace of cloud infrastructure growth relative to the peers. So management has also warned that margins could temporarily come under pressure as the data center investments ramp up ahead. Oracle recently signed a massive 5-year, $300 billion cloud agreement with OpenAI, including significant upfront payments. While the deal highlights strong AI demand, investors are questioning its sustainability of OpenAI-related spending and the payment capacity, given that OpenAI is now Oracle's largest customer. So despite impressive growth, worries over cash burn, massive capex, fresh fundraising, and margins pressure ended up overshadowing the earnings beat, something that the investors for Oracle Financial Services are likely to watch in today's session.
Thanks, Darshita, for that. Oracle under pressure after fundraising for AI. But another company which has raised fund is Zee Entertainment. The board has approved raising up to 2,300 crores, marking its third fundraising attempt in 2 years. The move comes as the company ramps up investments across sports, digital content, including FIFA rights, new sports channels, and Z5 expansion. Ashesha is here with the details.
Well, yes, Zee Entertainment is in focus today on the back of their fundraising plans. And as you mentioned, the company has informed the exchanges that they are looking to raise a minimum of 2,300 crore on the 10th of June. This will be by a preferential allotment, private placement that will be executed in one or more tranches, and the structure and pricing, of course, is yet to be decided. The regulatory filing also says that the company has stated that the funds of 2,300 crores will be utilized for strategic and business initiatives. They have not given specific contours, but strategic and business initiatives is why the fund is being raised. Meanwhile, remember, the company continues to remain in focus on the back of FIFA rights that they got a couple of days ago. But this is the third fundraising attempt that the company has done in the last 3 years. In June 2014, the company had raised about 2,000 crores via FCCBs. Later, in June 2025, the board also tried raising about 2,300 crores via promoter warrants to increase promoter holding from 4% to 18%, but this was rejected by the shareholders in the EGM that was held in July 2025. And now again, the company is attempting to raise about 2,300 crores. So yes, the entertainment in focus on the back of their fundraising plans yet again.
Oh, it is, and the stock is holding up very well, as are some of the other names. Look at an RBL Bank, that's one of your top movers too. But here's what else has been making headlines, and the US has concluded another round of strikes on Iranian military targets, hitting surveillance, communications and air defense infrastructure across multiple locations. Meanwhile, Iran has warned that they will block the Strait of Hormuz. Also, markets are closely watching the Bank of Japan ahead of its next week's policy meeting after the governor was hospitalized. While investors still expect the BOJ to raise interest rates, uncertainty has increased around the central bank's communication and policy guidance in UAE's absence. Also, Canada has proposed a new online safety rule that would bar social media access for children under 16 unless platforms meet strict safety standards. The legislation would also impose new obligations on AI chatbot providers. Also, the US dollar has remained near a 2-month high as investors sought safety following fresh US strikes in Iran. The disruption around Hormuz has heightened concerns, reinforcing expectations that global central banks may need to keep interest rates higher for longer. Also, gold prices remained under pressure as they are today, hovering near a 7-month low. Despite escalating tensions, surging energy prices and persistent risks have reinforced the view that central banks may keep policy tighter for longer, weighing on non-yielding assets like gold. And hours before the FIFA World Cup kicks off in Mexico City, authorities have ramped up security as multiple protest groups plan demonstrations. While the president has assured that preparations are on track, officials are bracing for disruptions from teachers, farmers and labor groups, speaking to press their demands during one of the world's most watched sporting events. And of course, for 17 years, your channel, ET Now, has empowered investors and decision makers with the insights needed to navigate India's growth story. In fact, continuing with that commitment, we bring you the ET Now Market Summit 2026, a gathering of India's leading economists, fund managers, policymakers and investment experts, including the likes of Sunil Singhania, Sandeep Tandon, Sandeep Sikka, Rhythm Desai and Vijay Kedia. They will be coming together to decode the future of Indian markets, a special event where SEBI Chairman Tuhin Kanta Pandey will be the chief guest and share his insights on navigating volatility. So stay tuned. Tomorrow it is an exclusive battery of insights and powerful conversation from the ET Now Market Summit 2026 beginning at 4 p.m.
Sala right here in ET Now. I'm Ashesha Advaryu, with me is Snehi Shah, and for the markets, absolutely flat at this point in time. Nifty is now trading at that 23,190 mark. We have slipped below the 23,200. But despite that, on the index level, absolutely flat at this point in time, and we have recovered from the lowest point of the day. Nifty Bank, that continues to outperform, trading with some amount of gains in trade today, 55,230 thereabouts. But this is a show where we discuss all the mid-cap stocks that are buzzing in trade. So let's get started with that one. And first up, let's talk about Domes Industries. The stock is in focus after the stationery company announced that it is acquiring Renault's stationery business in India, including key brands, intellectual property, manufacturing assets, contracts and employees for about $3.7 million US. The deal strengthens Dome's presence in school supplies by bringing the Renault's brands under its portfolio. The stock is up more than 5% on the back of this.
Another consumer outlined an ambitious FY31 roadmap at its analyst day yesterday, targeting 5,500 crore plus in revenue and 15% EBITDA margins, driven by scaling its core brands, expanding distribution and leveraging AI-led execution. Brokerages are constructive on this strategy, with Emkay maintaining a buy rating and a 500 rupees target price, while Goldman Sachs has retained its neutral stance but raised the target price to 400 rupees per share.
Meanwhile, sugar stocks like Balrampur Chini, Dhampur Sugar Mill, Sri Renuka Sugar are seeing sweet gains after the government abolished excise duty on petrol blended with higher levels of ethanol. Petrol containing 22% to 30% ethanol will now be exempt from excise duty, which is a positive development for sugar and grain-based ethanol manufacturers.
Another one to watch out for today is Zee Entertainment. That stock is doing well in trade. The company's board has approved raising capital of a minimum of 2,300 crore rupees in one or more phases or tranches, and this is being done to fund the company's strategic and business initiatives.
Meanwhile, WakeFit Innovations, Vidya Wires and Corona Remedies are all in focus today, as shares of Vidya Wires, WakeFit Innovations and Corona Remedies under pressure as lock-in period expires for 6%, 49% and 70% of their outstanding shares respectively, potentially increasing the free float and supply of shares in the market.
Okay, that's a roundup of all the stocks that are buzzing from the broader end of the market, but time now to dial up on the corporate conversations that we have lined up for you on the show. First up, we've got the management of Interarch Building Solutions, Mr. Arvind Nanda, the managing director of the company, joining us on the show. Mr. Nanda, hi, good morning and good to be speaking with you. Lots to talk about. Let's first start by talking about your latest order win, 58 crore rupees. That's the quantum of your new order win, and this is for a pre-engineered steel building system. Talk to us about this order a little bit more. Give us some more details in terms of what the execution timeline is going to look like, and also give us a sense of what the order pipeline is building up like right now.
Thank you very much. This order is for a manufacturing unit to come up in Tamil Nadu. So we are very big in manufacturing industry, and we do a lot of factories for various clients. So this is another win for us in the manufacturing industry. Our total pre-engineered building orders, as we declared last month after our board meeting, was about 1,700 crores. And so we are trying to keep it in that level, 17 to 1,800 crores, which will give us a pipeline of 9 to 10 months going forward. Because the critical part for any pre-engineered building company is the delivery of the order. Or taking the order is much simpler than actually delivering. So you have to deliver according to your capacity. So we feel that going forward with our target of 2,100 crores for the next year, I think an order book of 1,800 crores is very good going forward. So we are very happy with this new order win as well as our order book currently.
So 2,150 to 2,200 crore guidance, revenue guidance for FY27, that is what you just spoke about. But I assume this was given before this order win. So now with additional order win that you've informed the exchanges about, and probably new order wins that could come through over the next few months, would you want to revise your guidance upwards in that case?
I think we will wait, because the guidance doesn't depend on only the orders received, but also the order delivery, like I mentioned. So I think we will be in a better position by the end of second quarter, because our Gujarat plant is going to come into production in early July, as we had predicted. And then the second phase of Gujarat also will come up by August, September, October. It should be coming up. We are trying to prepone it from December. So I think once we have more capacity in place, then it helps us to predict better. Orders is not really an issue right now in the market, but we have to be very careful when we pick up the orders that we can deliver according to the timeline required by the customer. So the larger orders normally have a longer delivery period, but the guidance doesn't change right now with new order wins. These are expected order wins that we have to get. The guidance could change after the Gujarat plant is fully functional, and then we see maybe end of second quarter.
So we'll be watching out for that, Mr. Nanda. On the back of all your operational updates that you've been sharing with us, give us a sense of how do you see the margins shaping? Because we've seen a moderation for FY26 compared to FY25, and you've gotten really close to reaching the 10% mark for 2 years. Give us a sense of when you see your margins crossing 10%, and what would the medium-term guidance for your margins look like?
See, I think the margins should improve, definitely. But at any time, we are also investing into our future. Like if you look at our last year's accounts, I would say nearly 0.4% of EBITDA was lost. 0.4% EBITDA was lost because we had to get a lot of certifications done for our exports, spend money on that. Then due to the new labor code, the auditors insisted that we make a provision just in case what happened, because right now the rules haven't come in. But so we have made that provision also 3 to 4 crores of that. So we have to make provisions. We were getting into heavy structures. So a lot of expenses going into that also, while production will only happen in August onwards. So I think that keeps overlapping a little bit. It is important for us to plan for our future. We are not very happy with the margins that we make, but we are trying to work on both ends to improve our margins as we move up the value chain of getting bigger orders, more complex orders, execute them faster to make better margins, and also work on our internal economies like steel scrap wastage, production wastage, freight cost, purchasing becomes better as we grow bigger. So we are trying to work on all angles. I can assure you and our investors that we are very unhappy with our margin, but it's a struggle and it's an ongoing process to improve it.
The aim be, since you're telling us that you're working to improve your margins, I'm sure there's a target that you've set for yourself when it comes to margins.
Yes, I think we should be aiming for 10% at least going forward. But then, like I said, a lot of things happened. Like last year, suddenly the labor code came up. There had to be some certifications done. Exports will happen more this year onward, not in a very large volume, but they could only start once we have certifications. Then, of course, a lot of export expenses made by people traveling, etc. So these kind of things do happen. So we don't know whether what kind of expenses we'll have to make in exports this year. We have signed a MOU with a Canadian company. So we feel that our expenses could be limited because they'll be doing the selling and imports. But exports could increase. Heavy structure could entail some expenses going and meeting customers and doing some seminars, etc. But 10% is definitely our aim, if not more. That's the aim, immediate aim that we have.
Okay, we'll be watching out for this 10% number on your margins. Mr. Nanda, can you give us a timeline on by when your Gujarat facility is going to be operational? It was aimed for July this year. Can you give us a sense if you're on track?
Yes, it's on track.
Okay.
It'll be in the first half of July. There's a tentative phase 1 production dispatch happening from that plant. And this time we did both the phases, the building and the machinery was more or less ordered together. We are just giving it a gap of 3 to 4 months so that the labor can come in, the workers can come in, operators can come in, get the first line going, and then we immediately start on the second line. So this time we've done it a little differently. So there won't be a very big gap between the first phase and second phase of Gujarat. But first phase is definitely online in the first half of July.
And Mr. Nanda, you also generate significant revenue from export markets. Has there been any impact of West Asia crisis because of logistic problems or increase in logistic costs for that matter?
Well, fortunately or unfortunately, we don't have too much exports right now as a percentage of our, it is picking up. So we have currently orders from Africa, from Myanmar, from Canada, from US. So none of them are affected by the West Asia crisis. In fact, we feel that going forward, we might gain from that in terms that Middle East, which was a very, very big supplier of pre-engineered buildings worldwide, it might be a short-term gain for us in that sense. But there is no issue as far as our export markets are concerned, the West Asia crisis.
Okay, and on that note, Mr. Nanda, because of this crisis, we've seen a lot of momentum in steel prices. Has that impacted you? Have you taken any cost revisions on the back of this development?
Well, I think now it is more or less stable. January, February, March was a little bit of upheaval in that the prices, while they normally always go up in January, February, March, but it was a little bit more than they went up. Now they are stabilizing and coming down. We took orders based on future increase in price. Many of our customers, where we felt that orders were given at an earlier price, there were some delays by the customers. They've given us revisions also. So we've got revisions from the customers to supply at the higher price. Prices today are more stable. Then from January, February, March onwards, the orders that we have taken were always also considering that the prices are up. So overall, I think we'll manage the steel prices very well within this year. Maybe there's a little bit of problem in the first quarter with the second quarter, but overall in the 12-month period, I would say there will be zero effect.
Okay, so no impact of surge in steel prices. But Mr. Nanda, I believe there is some impact of rising receivables and operating cash flow. What is hurting operating cash flow? I believe it has turned negative.
Well, that was an issue in 31st March, our annual accounts, for two reasons, which I gave earlier also. One was that we have more orders in, large orders in the pipeline. They were being executed for large companies, semiconductors, electronics, etc., lithium battery. So there the debtors sometimes become a little larger because they are timeline, milestone payments, etc. And because of the rising prices, like you mentioned, we also built up a little bit of the stock. Bought the material a little more in advance than we would normally have done. So both these figures, advance stocks going up, debtors going up because of the larger orders in the execution at 31st March. And also, I think what we had to do a little bit was that, we had to make sure that the prices that we are getting for buying steel, we were getting better prices by paying cash down to the steel suppliers rather than giving them LCs. So that also brought our creditors down. So these three together happened because of steel price increases anticipated. We built up stocks. We paid the suppliers. That's why we didn't have any supply issues like a lot of other companies did have in January, February, March. And of course, larger projects. So these three combined together to have an operational cash negative. But I don't think it's something which will happen again.
So it was a one-off when it comes to operating cash flow. Mr. Nanda, thank you so much for taking your time out and joining us here in ET Now and taking us through the order win and what the outlook for the company for FY27 looks like. Thank you for joining us today.
Thank you very much.
And shifting focus from one corporate to another, then we are now joined by Mr. Sanjay Sharma, Managing Director at iFinance, who is now joining us. Mr. Sharma, good morning. Ashesha this side. Thank you for taking your time out. The company has raised funds to the tune of $15 million, and the stock has been in focus for the last several months on the back of that. But let's start with the AUM growth guidance that you have shared earlier with us, 25 to 30% growth guidance. How much of this growth is expected to come from existing customers versus new customer additions, and what's the outlook when it comes to AUM growth?
So thank you for having me on the show, and good morning, everyone. I think this $15 million facility that we have raised is in line with the aspiration that we have for growth. And since we deal with the micro-scale MSMEs, there's no dearth of demand because not many companies in the formal financial world address their working capital needs. So demand is not a challenge, and I think how we can supply and supply well is where the rub lies. We believe that 25 to 30% is where we want to be, and this raise of $15 million is aligned to that target. Also, it's interesting that despite so much noise about the volatility of the foreign exchange, etc., we are doing this deal at a price point where we are aligned to our target of reducing our borrowing cost this year. So even on that parameter, we're doing well.
Okay, understood. Mr. Sharma, hi. Can you tell us, given the increasing competition that we're seeing in MSME lending, what is keeping you confident of maintaining your growth while not affecting asset quality, while maintaining that aspect as well? Can you throw some light on this?
Sure. I think that's a very interesting question. And see, the customer that we deal with is the unorganized micro scale business, which is not linked to the supply chains of the formal world. So, in many ways, this unorganized small manufacturer of shoes or small manufacturer of cricket balls, etc., is insulated from the effects of the formal industry, and it is often, in many times, it is counter-cyclical to how the industry responds. So when you talk of MSMEs seeing some stress, etc., because of inflation, the war-related inflation, and logistic problems, our customer segment does not, because this customer segment produces basic essentials which are sold in the local market, and there's no dearth of demand. The demand, in fact, is very inelastic for many of these products. So I think we believe that that will continue. India has a very large consumption base at the bottom of the pyramid, and this is what our customers address. So we don't see a slowdown in that in any way.
Understood. So that's as far as MSME lending is concerned. But despite lower borrowing costs, guidance for net interest margins is only about 14.25 to 14.75%. What offsets the benefit of lower funding costs, and what's the outlook on net interest margins going forward if you would like to revise your guidance for FY27?
Sure. I think we will find that the net interest margin will stay close to 14.5%, which was the number last year. Primarily, there are 2 or 3 forces that will play out. One is that our cost of borrowing is expected to drop by almost 40 to 50 basis points, essentially because the inventory of our borrowing that we carry will gradually get replaced with new borrowing, which come at lower cost. The second parameter that will play out in the NIM is that on the interest rates that we charge our customers, there is no change at all. Hypothecation loan and mortgage loans, there are 2 main product lines. Hypothecation loan interests remain the same. Even the mortgage loan interests remain aligned to what the market rates are. The only difference is the mix of mortgage loans will change a little bit. And because of that mix increasing for mortgage loans, the NIM will tend to drop. But as the borrowing cost is coming down, it will in a way compensate for that.
Understood. So that sounds positive. Mr. Sharma, how matured is your current branch network, and what percentage of future growth can come without any significant branch additions? Do you have any plans of adding branches? If so, what would the regions be? Which geographies are doing well for you?
Yeah. See, we have a fairly large customer base. We have about 6.5 lakhs of active customers, and we generate almost close to 30 to 40,000 loans in a single month every month. I think the growth that you talk of comes to a large extent from existing branches which are growing their AUM base. And if I was to say that what is that 25 to 30% growth, where is it going to come from? Probably more than half will come from existing branches. Another quarter will come from repeat loans to existing customers, and only a quarter will come from looking at sourcing from new channels. Our expectation or plan for this year is to only add about 40 to 50 branches. We have a base of 577 branches. So you can say roughly 10% increase in branch, but a 25 to 30% increase in AUM is what we are targeting.
Okay, 25 to 30% AUM growth with branch expansion, but you expect credit costs to improve by nearly 100 basis points for FY27. What factors give you the confidence of this improvement, and how much of this expected reduction in credit costs will be driven by better realizations and improved underwriting?
Visha, this is primarily on account of the improved collection efficiency that we are seeing. And this is not for just a quarter. For the last 12 months, we've seen collection efficiencies improve. So that gives us that confidence that we are on a good track. Also, remember that we ended with a credit cost of 4.6% last year. And typically for our business, 3.5 to 4% is where we want to be. We ended the last quarter at 4.3, and this quarter we are likely to see us in that range of 3.5 to 4. So over the entire year, we believe that we will see a 100% drop. This is based on, one, the trajectory that we are on, the collection efficiencies that we see, and also as you grow, the impact, the bottom line increases, and therefore the impact reduces.
Right. Mr. Sharma, let's talk about your FY27 PAT guidance between 350 and 400 crore rupees. Now, that of course implies a sharp earnings acceleration compared to the previous years. Can you tell us among the factors like credit costs or funding costs that are coming down for you, or the growth plans that you've laid out, your branch expansion plans, amid all of this, what is going to be the biggest factor that contributes most to this steep jump in your profitability guidance?
Yeah. I think the number that you're seeing, while it may look phenomenal growth in PAT compared to last year, the last year we did a cleanup of our book, and the overlending related issues, etc., were completely cleaned out. We had a extra write-off of about 80 to 90 crores for the extra write-off. So if you add that back into this year, you will see that that number is not substantially larger. It's a good growth, but with lower credit costs. So if we have 80-90 crores of less credit cost, it will add to the bottom line. The second is that we also had incurred a fair amount of expense in setting up our mortgage business. In the last 2 years, we had hired close to 1,400 people, which this year we don't intend to extend much. Maybe we'll hire about 150 more people, but these will become productive in this year. And I think that will also help reduce the operating expense. So two aspects. One is the operating expense ratio itself will drop by almost 1 percentage points. And the credit cost, as I said, will not have that overhang of the overlending period.
Right, so that's the outlook going forward. Mr. Sharma, thank you so much for taking your time out and joining us here on ET Now. So that's the outlook on the fundraise that they've done and what the outlook is for the year ahead. But here's a quick programming update. For 17 years, ET Now has empowered investors and decision makers with insights that are needed to navigate India's growth story. Continuing that commitment, we bring to you the ET Now Market Summit 2026, a gathering of India's leading economists, fund managers, policy makers and investment experts, including the likes of Sunil Singhania, Sandeep Tandon, Sudhir Sikka, Ridham Desai and Vijay Kedia. They will be coming together to decode the future of Indian equity markets. A special event where chairperson of SEBI, Tuhin Kanta Pandey, will be the chief guest and share his insights on navigating volatility. Stay tuned to ET Now on the 12th of June for exclusive insights and powerful conversations from the ET Now Market Summit 2026.
Okay, with that, we're completely timed out on this edition of Midcap Masala. Thanks so much for tuning in, but keep watching ET Now because buy now, sell now takes all the action ahead.